On March 27, 1980, the price of silver crashed 50% in a single day. In just hours, two of America's richest men lost over $1.7 billion. That's $6 billion in today's money. Banks were on the verge of collapse. The stock market plummeted 10%. And the Federal Reserve had to orchestrate an emergency bailout to prevent the entire U.S. financial system from imploding. This was Silver Thursday, the day the Hunt brothers' attempt to corner the entire world's silver market came crashing down. These Texas oil billionaires had driven silver prices from $6 an ounce to nearly $50, an 800% increase by trying to buy up every ounce of silver on Earth. At their peak, they controlled over half the world's deliverable silver supply. They were so close to pulling off the greatest market corner in modern history. But in their greed, they'd made powerful enemies: the U.S. government, the Federal Reserve, and the entire commodities exchange system. Today, you're going to learn exactly how two brothers nearly broke the global financial system, why they thought they could get away with it, and the economic lessons that still apply to markets today. If you want to understand the economic stories that shaped our world while most people weren't paying attention, make sure to hit that like button and subscribe to The Sleeping Economist. Click the notification bell so you don't miss our next deep dive into the financial mysteries that changed everything. Chapter 1. The Texas Titans and Their Inflation Obsession. To understand how two men nearly cornered the world's silver market, you first need to understand who the Hunt brothers were and why they became obsessed with silver in the first place. Nelson Bunker Hunt and William Herbert Hunt weren't just rich, they were Texas oil dynasty rich. Their father, H.L. Hunt, had built one of America's largest oil fortunes from a single lucky oil well in 1930. By the 1970s, the Hunt family was worth over $5 billion, making them one of the wealthiest families in America. But Bunker and Herbert weren't satisfied with just inheriting wealth. They wanted to build an empire that would dwarf their father's. The 1970s were a scary time to be holding dollars. Inflation was eating away at wealth faster than a prairie fire. In 1974 alone, inflation hit 11%. By 1979, it would reach nearly 14%. This meant that if you had $1 million sitting in the bank, you were effectively losing $140,000 in purchasing power every single year. The Hunt brothers watched their oil fortune being eroded by inflation and decided they needed to protect their wealth. But here's where their thinking got interesting and dangerous. The brothers didn't just want to hedge against inflation like normal investors might by buying some gold or real estate. They believed the entire paper money system was about to collapse. Bunker Hunt was convinced that the US dollar would become worthless, that society would break down, and that only hard assets, particularly silver, would retain value. Why silver instead of gold? This is where the Hunts saw an opportunity that would eventually destroy them. Gold was already heavily regulated by governments. Americans had only been allowed to own gold again since 1974, after decades of it being illegal. But silver was different. It was an industrial metal used in photography, electronics, and jewelry. The government paid less attention to silver, and most importantly, the silver market was much smaller than gold, small enough that someone with a few $1 billion might actually be able to control it. The Hunt brothers started buying silver in 1973, slowly at first. They purchased physical silver bars and had them shipped to warehouses in Switzerland and New York. Think about that. They were buying actual silver, tons of it, and storing it in vaults. By 1974, they owned about 35 million ounces. At $6 an ounce, that was already a $200 million position. But this was just the beginning. What the Hunts understood, and what made their plan both brilliant and ultimately catastrophic, was leverage. They didn't just use their own money. They borrowed against their oil assets, their silver holdings, and anything else they could mortgage. They were essentially betting the family fortune on a single commodity. And they were about to discover that when you try to corner a market, the market has ways of fighting back. Chapter 2. Saudi Princes, Secret Vaults, and a Pyramid of Debt. This brings us to the critical period of 1979, when the Hunt brothers transformed from large silver investors into an existential threat to the global financial system. And they didn't do it alone. The Hunts realized that even with their billions, they couldn't buy all the world's silver by themselves. So they formed a partnership with wealthy Saudi Arabian investors, including members of the Saudi royal family. Together, this group had access to nearly unlimited oil wealth. They created offshore companies with mysterious names like International Metals Investment Company. The exact amount of Saudi money involved was never fully disclosed, but investigators later estimated it was in the billions. Here's where the story gets truly audacious. The Hunt brothers weren't just buying physical silver anymore, they discovered the futures market. A futures contract is basically a promise to buy silver at a set price on a future date. The beauty of futures, from the Hunt's perspective, was leverage. You only had to put down about 10% of the contract's value as margin. This meant with $100 million, they could control $1 billion worth of silver. By late 1979, the Hunt brothers and their partners had accumulated futures contracts for 200 million ounces of silver. To put that in perspective, the entire annual global production of silver was only about 250 million ounces. But here's where it gets interesting, and where regular investors started getting hurt. As the Hunts bought more and more silver, both physical and futures, the price started climbing. From $6 in early 1979, silver hit $11 by August, then $16 by September. Other investors saw the price rising and jumped in, pushing it even higher. By December 1979, silver was trading at $25 an ounce. The photography industry, which used massive amounts of silver for film, was in panic. Kodak, the largest user of industrial silver, was watching its raw material costs explode. Jewelry manufacturers were going out of business. The Hunt brothers were literally changing the global economy. The commodities exchanges started getting nervous. The COMEX in New York and the Chicago Board of Trade saw what was happening. The Hunts controlled so much silver that other traders couldn't function normally. The markets were supposed to be places where producers and consumers of silver could hedge their risks. Instead, they'd become the Hunt brothers' personal playground. In January 1980, the exchanges took their first major action. They raised margin requirements for silver futures from 10% to 25%. This meant the Hunts suddenly needed to come up with hundreds of millions more in cash to maintain their positions. But the brothers saw this as validation that their plan was working. They were so close to cornering the market that the establishment was trying to stop them. The Hunts responded by borrowing even more money. They took out loans from major banks, including First National Bank of Chicago and Chase Manhattan. It was a massive pyramid of debt built on a single commodity. By early 1980, the Hunt brothers owed over $1.5 billion to various banks. On January 21, 1980, silver hit its all-time high, $49.45 per ounce. The Hunt brothers' silver holdings were worth over $4.5 billion. They were on paper among the richest men in the world. Bunker Hunt reportedly boasted, "$1 billion isn't what it used to be." But unknown to them, the exchanges were about to change the rules of the game entirely. Chapter 3. Silver Thursday, the day the music stopped. But here's where it gets really dramatic. On January 21, 1980, the very day silver hit its peak, the COMEX exchange made an unprecedented decision that would destroy the Hunt brothers. They announced something called liquidation-only trading in silver futures. This meant you could only sell silver contracts, not buy new ones. Think about what this meant. The Hunts had spent years building their position, assuming the rules would stay the same. Suddenly, they were the only buyers left in a market where everyone else was forced to sell. It was like being in an auction where the auctioneer suddenly announces that bidding is over and everyone must sell at whatever price they can get. The price of silver immediately started falling. From $49 on January 21st, it dropped to $44, then $39, then $34 by the end of January. Each dollar drop cost the Hunt brothers about $100 million in paper losses. But the real problem was the margin calls. Here's how margin calls work, and why they're so dangerous. When you buy futures with borrowed money, you have to maintain a certain amount of cash in your account. If the price goes down, you have to add more cash immediately. The Hunts were getting margin calls for hundreds of millions of dollars every single day. By early March, the situation was desperate. The Hunt brothers were selling everything they could to meet margin calls. They sold oil properties, cattle ranches, even their stake in the World Championship tennis circuit. They borrowed from anyone who would lend to them. They even mortgaged their legendary collection of ancient Greek and Roman coins. On March 25, 1980, Bunker Hunt made a fateful phone call to Herbert Hunt. "Shut it down," he said. They couldn't meet a $135 million margin call due the next day. After 7 years of trying to corner the silver market, they were out of money. March 27, 1980, Silver Thursday. When the markets opened and word spread that the Hunts couldn't meet their margin calls, silver crashed from $21 to $10.80 in a matter of hours. It was the largest single-day percentage drop in commodity history. But the panic wasn't limited to silver. The stock market crashed too, dropping 10% as investors feared the Hunt brothers' failure would take down major banks. And they were right to be afraid. Botch Group, one of the largest brokerage firms in America, was owed $233 million by the Hunts. If the Hunts couldn't pay, Botch would go bankrupt. First National Bank of Chicago was exposed for $175 million. Chase Manhattan, Continental Illinois, and a dozen other banks had hundreds of millions in loans to the Hunts. The entire U.S. banking system was interconnected through these loans. If the Hunts went down, they could take the financial system with them. The Fed had to decide, let the free market work, and potentially watch the banking system collapse, or intervene to save banks that had made bad loans to speculators. They chose intervention. Chapter 4. When Billionaires Break Banks. The immediate aftermath of Silver Thursday was chaos. The Federal Reserve, which normally stays out of commodity markets, had to orchestrate one of the most complex financial rescues in history. They couldn't bail out the Hunt brothers directly. That would have caused public outrage. Instead, they had to save the banks without appearing to save the billionaire speculators who caused the crisis. The solution was ingenious and controversial. A consortium of banks led by the Federal Reserve provided a $1.1 billion loan to the Hunts, but with conditions that essentially ended their financial empire. The brothers had to pledge virtually everything they owned as collateral. Oil properties worth billions, their homes, their art collections, even their wives' jewelry. They went from being worth $5 billion to being essentially bankrupt, but with enough breathing room to avoid taking down the banks. The silver market itself was devastated. Thousands of small investors who had followed the Hunts' lead lost everything. The Hunt brothers had created a bubble that sucked in ordinary people, then left them with the losses. The commodities exchanges faced intense scrutiny. Congressional hearings were held to investigate how two men had been allowed to accumulate such dangerous positions. The Commodity Futures Trading Commission, which was supposed to regulate these markets, was revealed to be toothless. Major banks had to write off hundreds of millions in losses. Continental Illinois, which had loaned heavily to the Hunts, never fully recovered and eventually failed in 1984. The episode exposed how interconnected the financial system had become and how the failure of just two speculators could threaten the entire economy. International ramifications were severe too. The Saudi investors who had partnered with the Hunts lost an estimated $1 billion. This created diplomatic tensions and led to new restrictions on foreign investment in U.S. commodity markets. India, which had seen massive outflows of silver during the price spike, had to deal with the cultural disruption of families having sold ancestral silver. The photography and electronics industries, which had been paying artificially high prices for silver, saw their costs plummet but had to deal with the whiplash of such volatility. But perhaps the most significant fallout was the loss of trust in markets. The fact that two individuals could manipulate a global commodity price so dramatically, and that exchanges could change rules mid-game to stop them, shook faith in the fairness of the financial system. Chapter 5. From $5 billion to Bankruptcy Court. The legal consequences for the Hunt brothers dragged on for years. In 1988, they were found guilty of conspiring to manipulate the silver market and ordered to pay $134 million in damages to Minpeco, a Peruvian mining company that had lost money due to their manipulation. By then, they didn't have $134 million. They declared bankruptcy. These men went from inheriting one of America's great fortunes to nearly cornering the world's silver market, to personal bankruptcy in less than a decade. Bunker Hunt, once worth $3 billion, was reduced to declaring assets of $10 million and debts of $250 million in his bankruptcy filing. The regulatory changes that followed were sweeping. The Commodity Futures Trading Commission was given real teeth, with the power to set and enforce position limits. Today, no one can hold more than 3,000 contracts in silver futures, a tiny fraction of what the Hunts accumulated. Banks faced new restrictions on lending for commodity speculation. The Federal Reserve implemented rules requiring higher capital reserves for loans secured by volatile commodities. The era of banks freely lending billions for market corners was over. The exchanges themselves were reformed. The power to change trading rules mid-crisis, like the liquidation-only order that destroyed the Hunts, was curtailed. New procedures were put in place requiring regulatory approval and advance notice for major rule changes. But here's what's fascinating. The Hunt brothers never fully accepted responsibility. Bunker Hunt maintained they were victims of a conspiracy by the exchanges and the government. He claimed they weren't trying to corner the market, just protecting their wealth from inflation. When asked if he had any regrets, he famously said, "I'm not a quitter. I'll come back." He never did come back. The Hunt family fortune, built over generations, was largely destroyed. Properties were sold off piece by piece. The legendary Hunt oil fields were divided among creditors. By the time Bunker Hunt died in 2014, the man who once tried to corner the world's silver market was worth less than $10 million. The silver market itself took years to recover. It wouldn't reach $20 again until 2008, during the financial crisis. Even today, silver trades at less than half the peak price the Hunt brothers achieved. The market learned to be suspicious of rapid price increases and large concentrated positions. Chapter 6. Why every market corner eventually collapses. So what can regular people learn from the Hunt brothers' spectacular rise and fall? First, beware of anyone trying to corner a market. When you hear that a small group controls a large percentage of any asset, whether it's silver, Bitcoin, or GameStop shares, that's a red flag. Second, leverage is a double-edged sword that cuts deep. The Hunt brothers didn't just lose their initial investment. They lost everything because they borrowed to invest. When you borrow to buy assets, you amplify both gains and losses. A 50% drop in price can mean a 100% loss of your investment if you're leveraged. Third, the house can change the rules. The Hunt brothers learned this the hard way when exchanges changed trading rules mid-game. Today's investors should remember that exchanges, governments, and regulators have tremendous power to intervene in markets they view as dysfunctional. Fourth, inflation fears can lead to irrational decisions. The Hunt brothers were so afraid of inflation destroying their wealth that they took actions that destroyed it even faster. Fifth, diversification matters more than conviction. The Hunts put everything into silver because they were absolutely convinced they were right. But markets have a way of humbling even the most convinced investors. Finally, and perhaps most importantly, market manipulation eventually fails. Every corner in history, from the original corners in grain markets to modern attempts in stocks and cryptocurrencies, has eventually collapsed. The Hunt brothers controlled over half the world's silver and still couldn't maintain their corner. Markets are bigger than any individual or group. The Hunt brothers' story is ultimately a cautionary tale about hubris. They believed they were smarter than the market, richer than the system, and powerful enough to bend economic reality to their will. They were wrong. The free market, for all its flaws, has defense mechanisms against those who would control it. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel because we're just getting started with these financial, educational mysteries.